Picture Wall Street in 2006. Bonuses are record-breaking. Banks are printing money. And almost nobody is worried. Almost. Because deep inside Deutsche Bank, one analyst is staring at data that makes his stomach drop. And he's about to make the most controversial bet in modern financial history. His name is Greg Lippmann. And this is the story of the man who saw 2008 coming and bet his career on it. To understand what Lippmann saw, we need to go back, way back, to a quieter America. The year is 1996. Home ownership is the American dream, and the government wants more of it. Federal policy is pushing banks to lend more, to more people, even people who couldn't traditionally qualify. This sounds generous, noble even, but it plants a seed, a very dangerous seed. By the early 2000s, interest rates are at historic lows. The dot-com bubble just burst, and money needs somewhere new to go. Wall Street finds its answer: mortgages. Banks start packaging home loans into bundles, selling those bundles as investments, called mortgage-backed securities. It seems genius. Banks lend money, package the loans, sell the risk, collect fees. Everyone wins. Or so they think. Here's the problem nobody wants to say out loud. The more mortgages you sell, the more fees you make. So banks stop caring whether borrowers can actually repay. Enter the subprime mortgage. Loans given to people with poor credit, low incomes, sometimes no income verification at all. These were called ninja loans. No income, no job, no assets. Approved. By 2005, 20% of all new mortgages in America are subprime. The machine is running hot. And Greg Lippmann notices something. He's running the asset-backed securities desk at Deutsche Bank. His job is to understand this market deeply, and what he sees frightens him. Default rates on subprime loans are already ticking up, even while house prices are still rising. That's backwards. That's wrong. He starts building a case, slide by slide, number by number. A presentation so damning it would later be called the most important PowerPoint in finance history. Its title? Shorting Home Equity Mezzanine Tranches. Translation: betting that the mortgage market is about to collapse. But first, what even is a CDO? Because this is where things get truly wild. Imagine you have 1,000 mortgages. Some are solid, some are risky. You bundle them all together. Then you slice that bundle into layers. Top layers safe, first to be repaid. Bottom layers risky, last in line. These slices are called tranches, French for slices. Wall Street loves a French word. Now here's the genius and the madness. Rating agencies look at that top slice, see mostly good loans near the top. Give it a AAA rating. Safest possible. Pension funds, insurance companies, foreign banks, they all buy it. Because AAA means safe. Theoretically. But Lippmann is asking, what happens to those safe top slices? When the entire mortgage market turns bad. When not 5% of loans default. Not 10%, but 20%, 30%, 40%? The math gets ugly fast. So he builds a weapon to profit from the collapse. A financial instrument called a credit default swap. Essentially, insurance against mortgage failure. You pay a small premium every year. If the mortgages default, you collect a massive payout. Lippmann starts going around to hedge funds, pitching his idea. The housing market will collapse. Bet against it. Here's how. Most people laugh him out of the room. Housing prices have never fallen nationally. You're being alarmist. Go home, Greg. But a few people listen. And those few people will change history. One of them is Michael Burry, a one-eyed doctor turned hedge fund manager in California, who has been reading every mortgage prospectus he can find. Loan by loan. Page by page. Late nights. Weekends. What he finds horrifies him. The loan quality is getting worse every quarter. Interest-only periods hiding unaffordable payments. Adjustable rates about to reset to levels borrowers cannot pay. Burry quietly goes to the banks. Asks them to create credit default swaps on the very products they are selling. The banks agree. They think he's insane. They take his premiums happily. Easy money, they figure. Meanwhile, house prices keep rising. Lippmann's trade keeps costing Deutsche Bank money in premiums. His bosses are furious. They take his premiums happily. Easy money, they figure. You're burning the firm's money on a crazy bet. Internal pressure mounts. But Lippmann holds. Because the data doesn't lie. By early 2006, delinquency rates on subprime mortgages are rising faster than any model predicted. And house prices have quietly, almost invisibly, begun to fall. Not dramatically. Not yet. Just a whisper. A whisper that will become a scream. At the same time, Wall Street is building something even more dangerous. CDO squared. CDOs made of other CDOs. Bundles of bundles. Risk compressed and hidden layer upon layer. It's like making sausage from sausage. And selling it as filet mignon. Nobody checks what's inside. The ratings agencies, Moody's, S&P, Fitch, are still handing out AAA ratings. Because their models assume housing prices only go up. Because their fees come from the banks paying them to rate the products. The conflict of interest is breathtaking. In Nevada, a strawberry picker earning $14,000 a year has been approved for a $720,000 home. In Florida, a house cleaner owns 5 properties. In California, condos are being flipped like stocks. Lippmann sees all of this. His presentation grows darker. His position grows larger. By mid-2006, he has convinced a handful of hedge funds. Funds like Front Point Partners and Cornwall Capital. Small players. Outsiders. The ones willing to be wrong for a while. Their combined bet. Over $1 billion against the U.S. housing market. Then comes 2007. February 2007. HSBC announces massive subprime losses. Shock ripples through the market. But Wall Street brushes it off. Isolated. Contained. Fine. April 2007. New Century Financial, one of the biggest subprime lenders, files for bankruptcy. Still the denial holds. June 2007. Bear Stearns announces 2 of its hedge funds have collapsed. Invested entirely in subprime mortgage securities. Now people start to sweat. Lippmann's position is finally, starting to pay off. The credit default swaps he bought for pennies are now worth fortunes. Every day, the market moves in his direction. Every day, the people who laughed at him lose more money. But here's what most people miss. This was never just about money. It was about system failure. The entire architecture of modern finance was built on a lie. And now that lie was unraveling. By August 2007, the interbank lending market is freezing. Banks don't trust each other anymore. Because nobody knows how much toxic debt anyone is holding. March 2008, Bear Stearns, one of Wall Street's oldest firms, collapses in 72 hours. The Federal Reserve engineers a desperate rescue. JP Morgan buys it for $2 a share. A company once worth $170 per share. Lippmann and his allies watch this happen. The thing they predicted happened. And yet it's not over. The real catastrophe is still coming. September 7, 2008. The government seizes Fannie Mae and Freddie Mac, the 2 mortgage giants that guaranteed half of all American mortgages. Nationalized. Overnight. September 15, 2008. Lehman Brothers files for bankruptcy. The largest bankruptcy in American history. $613 billion in debt. Markets go into freefall. The Dow Jones drops 504 points in a single day. Money market funds, considered as safe as cash, begin to break. Credit markets freeze completely. Businesses can't borrow to make payroll. The world economy is at the edge of a cliff. And now, only now, does the mainstream world understand what Lippmann saw in 2006. The trade pays off almost beyond imagination. Deutsche Bank earns $1.5 billion from Lippmann's position. Michael Burry's fund returns 489% to his investors. The hedge funds that followed Lippmann's call each make hundreds of millions. But there is no celebration. Because while they profit, millions lose. 8 million Americans lose their jobs. 6 million families lose their homes. Retirement savings evaporate. Small businesses disappear. Communities collapse. Suicides rise. A generation's wealth gone. The government responds with TARP, the Troubled Asset Relief Program. $700 billion in taxpayer money to bail out the banks. The same banks that created this disaster. Not one senior banker goes to prison. Let that land. In the aftermath, Congress passes the Dodd-Frank Act. New regulations. New oversight. Attempts to prevent it from happening again. Rating agencies change their methods. Banks are required to hold more capital. Derivatives markets get some sunlight. But the deeper question lingers. How did an entire industry, full of the smartest, best-paid people on earth, miss something that one analyst spotted in a spreadsheet? The answer is uncomfortable. They didn't miss it. Many of them knew. They just had too much to gain to stop. The incentive structure rewarded short-term profits, annual bonuses, quarterly earnings. Nobody was paid to think about 2008 and 2005. Lippmann himself has said he was motivated partly by data, and partly by frustration, at a system that made no sense, at colleagues who stopped asking hard questions. He became famous, then infamous, then famous again, portrayed by Ryan Gosling in The Big Short, slightly fictionalized, called Jared Vennett in the film, but absolutely unmistakably him. After 2008, he left Deutsche Bank, co-founded his own hedge fund, LibreMax Capital, focused on structured credit. Still reading mortgage data. Still finding what others miss. So what do we take from all of this? First, contrarian thinking is hard. Not because the data is hidden, but because the social pressure to conform is overwhelming. When everyone around you is getting rich, doubt feels like stupidity. Second, incentives shape reality. The bankers who ignored the data weren't all evil. Many were captured by a system that rewarded them for ignoring it. Third, complexity is a hiding place. CDOs, tranches, credit default swaps. The jargon wasn't accidental. Complexity creates distance between the decision and the consequence. And that distance is where risk hides. Fourth, the cost of financial failure is never just financial. Every percentage point of unemployment is a family, a person, a life derailed. And fifth, perhaps most important, someone almost always sees it coming. The warnings are there. In the data. In the footnotes. In the questions nobody wants to ask at the meeting. The question is never whether the signal exists. The question is whether anyone has the courage, and the stubborn independence, to follow it wherever it leads. Greg Lippmann followed it. Into ridicule. Into internal warfare at his own firm. Into a bet that required him to be right about something. That the entire financial establishment insisted was impossible. He was right. And the world has never quite recovered from what happened when everyone else was wrong. If you found this story as fascinating as I did, subscribe. We cover the greatest moments in finance history every week. Drop your thoughts in the comments. What crisis do you think is being ignored right now? See you in the next one.